what a federal budget. 2026, probably the biggest budget and changes we've seen for a long time. It's the morning after, a lot of this is still fresh, there's not a lot of details, but I want to share some insights from ourselves in a pretty raw fashion coming across. General disclaimer, this is not advice, don't go and do anything this afternoon based on this information or any changes. A lot of these changes aren't coming in for a period of time, and there's a lot of detailed legislation we don't have yet. But there are definitely some things that people need to know, and there's some news headlines and bits and pieces, but we wanted to kind of give you our insights from where we're at. So there's some good news I'll get to later, but there are definitely some big changes coming. So a couple of big changes. Number one is capital gains tax. The capital gains tax system is changing. At the moment, has been for a fair while, a reasonably straightforward, depending on your gain, as long as you've owned for more than 12 months, that just gets halved, 50% discount, and then you pay tax on that. There's a lot of cool or exciting tax planning we can do to help reduce that or move that around as people's situation changes. Those are gonna change. It's not coming in until 1 July 2027. Still got plenty of time to sort this through and figure it out, but the change is coming is significant in a few different parts. One, we're going to what's called an indexation style of calculation. Makes it a bit more nerdy. We're gonna have to get some numbers and figures, and everyone's situation is gonna be slightly different. If two different people make a $100,000 gain, they're potentially gonna have very different taxable outcomes. Rather than just being a straight halving of your gain, it's what year did you buy it, how long have you held it for, what year are you selling it, how much did inflation go up during that period of time. So in theory, the longer you hold it, maybe the less tax you're gonna pay. But if you hold it in those 3 years versus someone else holding in a different 3-year cycle, there'd be different taxable elements about all of that. Don't need to jump and solve all that today, but just knowing that those are gonna change. That is gonna impact basically every property and share asset and potentially some business assets, potentially, except for new properties purchased. But it's going to affect new assets you buy from today or tomorrow. It's also going to affect existing assets that are already in place. They're going to have a bit of a hybrid method, some under the old system, some under the new system. As mentioned, we've still got well over a year to sort all that out, but there's definitely a change coming there that needs to be factored and considered through. Some of that we probably had been leaked over for last few days or weeks and months, we knew was coming. The second part of that is definitely a bit of detail in there that had kind of really been leaked, and that is that capital gains are going to come with a minimum 30% tax. Now, 30% tax of what they're calling the real gain. So after that inflation's taken off, you then pay tax on that. At the moment, a lot of the tax planning and strategies potentially around delaying some of those sales, sell them in different years, sell them in years when you're not working, so you're lower tax bracket. This 30% minimum, I suppose, is somewhat negate or offset that, or disencourage some of that spreading out of sales to reduce tax. There are still going to be some ways to save on tax, but this is kind of going to have a bit of a flaw. So it used to be a case of, well, I'll wait till I retire, I'll sell that gain then, I don't have wages, I might be paying less tax. This, it still may be you're paying less tax, but maybe not as little as it was the plans before. So this change is going to impact some things there. Again, doesn't come in until 1st of July 2027, but there may be some situations where, not today, again, general advice, but maybe we're selling a bit before that. If it's something you were going to plan to sell anyways, maybe there's still some other ways to work that around, but definitely some change to consider and think through with your advisor as part of this. There's lots more detail in there, but let's not make this an hour recording. Number 2, negative gearing on existing properties is changing. So these are newly acquired existing properties. So there's an exemption for if you're negatively gearing a property today, that can continue. Importantly, if you're negatively gearing shares today or plan to negatively gear shares in the future, that will also continue. This is just negatively gearing existing properties purchased kind of from today and comes into effect on 1 July 2027. Only for existing properties. If you want to go and buy a new property, you can still negatively gear that, but new existing dwellings that you purchase, that the interest cost may be more than the rent coming in. At the moment, you can offset that against your wages and get some tax back. That's going to be off the table from 1 July 2027. If you do make a loss, you can offset that against other rental profits if you've got more than one property, or it gets carried forward every year until you start making rental profits till it's positively geared, and you can offset some losses there. A big change. For retirees, our main focus is more cash flow. So negative gearing is not a large part of strategies we generally recommend. Everyone's situation is different, but definitely a big change for the society as a whole, and some tax planning that many people have done for many years is going to look different over the next few decades. Third one, and again, doesn't apply to everyone's situation. They say roughly around 5% of Australians use a trust. Lots of business owners and or wealthy retirees kind of use trust in different varieties and structures, and is a large part of strategy planning we do for many clients. That's also a change happening, and the change is big enough that they're delaying that by another year. It's not coming into 1 July 2028, but at the moment the definition is trusts don't pay tax. As long as they distribute that profit to somebody, that final beneficiary pays the tax at their marginal tax rate. Trusts will still be able to distribute through to a final beneficiary, but on the way through, trusts are going to need to withhold 30% of tax. So a trust makes $100,000, it's going to have to take out $30,000 and have $70,000 left over. That then can be distributed some to mum and dad. They get that 30% tax credit paid as what's called a non-refundable tax credit. Different to if you prepaid some tax or tax on your wages or franking credits, they're refundable credits, i.e. if tax has been taken out at 30%, but you're only meant to pay 20, you get that back. This is going to be a non-refundable franking or tax credit, meaning if you're meant to pay only 20 grand in tax and they're deducted 30, you don't have to pay the 20 again, but that extra 10 you paid, that gets forfeited. So there's definitely going to need to be some planning and restructuring. Trusts are very much still going to have their place, and there's some cases where they're going to continue to be as strong as they were before, but there's going to be some areas where they're not as attractive. We've got some clients for various reasons where we're distributing through to grandchildren or nieces and nephews or people who are on a lower tax bracket and then kind of allocating a certain amount tax-free or at a much lower tax rate. This is potentially going to change that. There's also question marks around trust distributing through the bucket companies to limit some tax on that. That's the detail that's not out yet, but they're definitely going to keep an eye on that. And potentially that strategy is going to have to change as well. There's some clients that I know look after that I'm going to have a big chat with you. If you think it's you, it probably is you. If you don't know what I'm talking about and you've got some trust, make sure you're working with an advisor or reach out to one of us, myself, Wayne and Jesse. We've already had a chat this morning about how this is going to start to impact some strategies and clients. And importantly, there's nothing to do today, but knowing that you've got some plans and you've got someone helping you through those plans to kind of get through all the headlines. How does it apply to you? How does it affect you? That's some big changes coming, but also importantly, kind of spaced out. I won't go through the political side of are these the right decisions or not. They are what they are. We don't make the rules. We just have to play by the rules and make sure that they're factored into your best situation. It is going to mean that for some situations, plans need to be reassessed. Again, nothing in the next month or even potentially in the next year. But if the plan was, okay, well, we'll sell that asset in 5 years' time and when we retire and we'll probably pay less tax, you still might pay less tax than today, but maybe not as little as you were thinking before. So maybe we don't hold off until then, maybe do sell sooner and pay down that debt faster. There are some wins, there are some positives. The positives are there's some small income tax rebates coming from 1 July 2026, some extra kind of little in the margins. There's some extra tax offsets for workers that will also come in the future. There's also some extra kind of rebates if you're a low income earner putting money into super. There's less tax you've got to pay on super. And that is my other biggest win. Out of all these changes, there've not been any changes to super that make that less attractive. All this capital gains stuff, the super rules are different. Super funds can still get the capital gains discount. If you sell an asset once you're in pension phase in super, that is still taxed at a 0% tax environment. The ability to put concessionals in and non-concessionals into super are all still there. In fact, on 1 July this year, those thresholds and limits are going up. So I think that is my other biggest win. For us, super has always been a haven of where we want to build your wealth. These changes make that even only more important. Perhaps we're not building as much wealth outside of super now and putting it in later. Some of these might be, okay, well maybe I'm actually better off paying a bit more tax today, moving that asset to super sooner, so that the future growth is going to be at a much better tax bracket than it's potentially going to be under some of these changes. Again, this is a bit of a debrief, general advice. Where it's applying to your situation, myself, Wayne and Jesse will reach out to you and talk that through with you. It's probably not a today urgent thing or a this week urgent thing, but if that's a concern to you, definitely reach out to us. That's what we're here for. But because all these changes are coming in at least 12 months away, when we next catch up with you, when we next have your planning meeting, these changes, where they apply to you, will definitely be on the agenda to discuss. And we're going to have time to reassess and rejig if and when appropriate. And it may not be the case of going, yep, it might mean we have to pay an extra $5,000 in tax, but that is still the best strategy. And you're still going to be okay, even if these changes are a little bit different to what was originally anticipated. If you're not working with an advisor and you're watching this because you've been sent this by a friend or something like that, that would probably be my advice as part of this, is that this stuff's complex. This is what we do day in, day out. Hopefully you can see that we love it, we enjoy it, and we like helping people through this space. So if you're watching this and you know you've got a friend who's got some properties or has some investments or inheriting some assets, they need to be across these changes. So feel free to send it to somebody. If you want to have a chat, Financial Edge Group, you can jump on our website and book in a phone call or reach out to us to make sure we're the right fit for you. And if we're not, we'll find someone who can definitely help. And or there's lots of other videos on YouTube, and I think there's going to be some more coming with some of these changes as well. So hopefully that helps. Again, general disclaimer, don't change anything today, but you need to be across some of these changes coming in the future. I'm Martin McGrath, hopefully that helped.